I think what's happening with AI in some ways is kind of separate from the general economy now, as far as this massive spending on capital expenditures and NVIDIA chips and that sort of thing. So I don't know if it would impact say consumer focused businesses or industrials, that sort of thing. But I do think it would kind of cause other valuations to shrink as well. I mean, I think that just the AI narrative is driving so much of the stock market's gains over the last 2 years. I mean, I would look for, that sounds like maybe you're looking for protection from that kind of event. So I would look to maybe dividend stocks or safer stocks that are going to be sort of more unfazed by the cyclical nature of technology and the hype around AI. I mean, I don't really feel like there's a specific kind of sector that's waiting in the wings to take over if the AI trade fades. But something could emerge. But I think right now that's really dominating the market narrative.
Yeah, I mean, consumer names, I don't think would get. I mean, they would get hit with everything else in the market, but it's still early stages of how much AI is playing into their business and benefiting them. I mean, they're all saying they're using it. They're all saying they're incorporating it into their businesses. How much revenue they're actually generating from directly from AI is still to be known. But are people still going to eat out? Yeah, maybe less, but they'll probably still eat out. Will they drink beverages? Probably. Will they buy things at Home Depot or malls or stores? Probably. Will they still go to Amazon? Probably. So lots of different businesses that are still, you could look to industrials, you could look to, last I checked, Berkshire Hathaway is at an all-time high, or close to an all-time high. I don't know if it hit it and it came off a little bit, but I wouldn't suggest buying it at its all-time high, but it does beg to question. I would argue that Berkshire Hathaway is probably more diverse than the S&P index, because the S&P index is heavily weighted towards these tech companies that could potentially get hit really hard if the AI trade or the AI wave slows down. I mean, I think it's here for good. It's a secular trend. But if you look at Berkshire, and I haven't had a chance to look at their Buffett's annual letter, but his business is very diversified. I don't think he has any exposure to AI except maybe Apple. But I know he's reduced some of that. He has a huge cash hoard. So that's people have been trying to digest and figure out what that means. But he's still pretty heavily invested in the collection of businesses that he has, railroads, basically everything that powers the U.S. economy. So honestly, if I would say, if you're looking for a more diversified kind of one-shot investment, Berkshire could be a good one versus S&P. And Berkshire being at an all-time high is more driven by its earnings and its fundamentals than the S&P. The S&P is being driven a lot more by tech, and while they're also producing earnings and cash flows, they're also subject to taking a big hit. So
yeah, that's a good point. Yeah, Berkshire is maybe a good way to get some diversification against some of the big tech that really is dominating the S&P 500 and the major indexes.
But I like what you said too about dividend stocks. Take a look at dividend stocks and get paid those dividends, and give yourself some cushion.